A common question we're starting to receive is, with current levels of market volatility, can I still retire? This is a super important question to ask, and ultimately the answer depends on one thing: your financial plan. Market volatility, while not fun, is part of being an investor. If you don't have a solid, well thought out financial plan in place with provisions for this type of market environment, it can lead to high levels of uncertainty and, quite frankly, significant amounts of stress surrounding your finances. Here's the bottom line: don't retire without a clearly defined financial plan for your retirement. Hope is not a plan. A great financial plan is going to serve as your roadmap, guiding you through complex decisions that determine your financial security and being able to achieve your long-term financial goals. It will help address key considerations within your investment portfolio. Let's dig into a few of them. First and foremost, your financial plan will help verify the appropriate levels of liquidity or cash to be able to keep on hand. The amount of cash that you have on hand should help address short-term financial expenses, as well as help you be prepared for being able to sustain a short-term market correction. Now, when you're in your retirement, one of the new risks that you have is something that's called sequence of returns risk. Now, what exactly is this? It deals with the timing of negative market performance and how it can have a long-term impact on your portfolio. Here's an example. On the left, we have investor A. They retired when markets were performing very well. On the right, we have investor B, who wasn't quite so lucky. Over both of their respective retirements, they both achieved, on average, the same rate of return. The only difference was the timing of the positive versus negative markets. Unfortunately, investor B retired when the markets were negative. And as we can see, this has a long-term detrimental impact to the value of their investment portfolio. So the big question here is, does your financial plan address this risk? The third thing I'll address here is portfolio allocation. A well-constructed financial plan will verify how much risk and long-term growth your portfolio should have in order to help sustain your retirement withdrawals and hit your long-term financial goals. Without this roadmap to verify your investment portfolio, it becomes very easy to take on too much risk, and in downward market cycles that can lead to adverse consequences, or take enough risk and your investments don't grow quite enough to achieve the long-term financial goals that you had set out to do. These are essential components of a well-constructed financial plan. With the right strategies and expertise, you can confidently retire even in a volatile market. Remember, the key here is preparation. Don't leave your future to chance. Invest the time in planning, and you'll gain clarity, control, and peace of mind for this next great chapter of your life.